Good morning, Mr. Buffett and Mr. Munger. My name is Steve Yates. I'm from Chicago. I'm a Berkshire shareholder, and this is my 6th year coming to this meeting. I'd like to thank you for all your time and advice through the years. It's been great. I'd also like to thank all those wonderful people who sold Berkshire this year for giving us an opportunity to purchase more of the world's greatest company for dirt cheap prices.
We will convey your thanks.
I own another stock which sells for 4 times current trailing earnings. Every quarter we get a report. Earnings go up, sales go up, cash flow goes up, the equity base expands, they gain market share, and the stock goes down. The company has a 60% 5-year annualized growth rate and sells at 4 times earnings. I have 2 related questions. First, is this a growth stock or a value stock? And could you please give us your definitions of these terms? Second, the company sells recreational vehicles. Demographic trends in the recreation and leisure areas, RVs, cruise lines, golf equipment, etc., seem to be quite good. Do you see any opportunities for Berkshire here? Thanks.
Well, the question about growth and value we've addressed in past annual reports, but they are not 2 distinct categories of business. Every business is worth the present. If you knew what it was going to be able to disgorge in cash between now and Judgment Day, you could come to a precise figure as to what it is worth today. Now, elements of that can be the ability to use additional capital at good rates. And most growth companies that are characterized as growth companies have that as a characteristic. But there is no distinction in our minds between growth and value. Every business we look at as being a value proposition. The potential for growth and the likelihood of good economics being attached to that growth are part of the equation in evaluation. But they're all value decisions. A company that pays no dividends, growing 100% a year, is losing money now. That's a value decision. You have to decide how much value you're going to get. Actually, it's very simple. The first investment primer, when would you guess it was written? The first investment primer that I know of, and it was pretty good advice, was delivered in about 600 BC by Aesop. And Aesop, you'll remember, said, "A bird in the hand is worth 2 in the bush." Now, incidentally, Aesop did not know it was 600 BC. He was smart, but he wasn't that smart. Now, Aesop was onto something, but he didn't finish it, because there's a couple of other questions that go along with that. But it is an investment equation. A bird in the hand is worth 2 in the bush. He forgot to say exactly when you were going to get the 2 from the bush, and he forgot to say what interest rates were that you had to measure this against. But if he'd given those 2 factors, he would have defined investment for the next 2,600 years, because a bird in the hand is, you will trade a bird in the hand, which is investing. You lay out cash today, and then the question is, as an investment decision, you have to evaluate how many birds are in the bush. You may think there are 2 birds in the bush or 3 birds in the bush, and you have to decide when they're going to come out and when you're going to acquire them. Now, if interest rates are 5% and you're going to get 2 birds from the bush in 5 years, we'll say, versus 1 now, 2 birds in the bush are much better than a bird in the hand now. So you want to trade your bird in the hand and say, I'll take 2 birds in the bush, because if you're going to get them in 5 years, that's roughly 14% compounded annually, and interest rates are only 5%. But if interest rates were 20%, you would decline to take 2 birds in the bush 5 years from now. You would say that's not good enough, because at 20%, if I just keep this bird in my hand and compound it, I'll have more birds than 2 birds in the bush in 5 years. Now, what's all that got to do with growth? Well, usually growth people associate with a lot more birds in the bush, but you still have to decide when you're going to get them. And you have to measure that against interest rates, and you have to measure it against other bushes and other equations. And that's all investing is. It's a value decision based on, what it is worth, how many birds are in that bush, when you're going to get them, and what interest rates are. Now, if you pay $500 billion, and when we buy a stock, we always think in terms of buying the whole enterprise because it enables us to think as businessmen rather than as stock speculators. So let's just take a company that has marvelous prospects, is paying you nothing now, and you buy it at a valuation of $500 billion. Now, if you feel that 10% is the appropriate rate of return, and you can pick your figure, that means that if it pays you nothing this year, but starts paying next year, it has to be able to pay you $55 billion in perpetuity each year. But if it's not going to pay until the third year, then it has to pay you $60.5 billion in perpetuity to justify the present price. Every year that you wait to take a bird out of the bush means that you have to take out more birds. It's that simple. And I question in my mind sometimes whether people who pay $500 billion implicitly for a business by buying 10 shares of stock at some price are really thinking of the mathematics implicit in what they are doing. To deliver, let's just assume that there's only going to be a 1-year delay before the business starts paying out to you and you want to get a 10% return and you pay $500 billion. That means $55 billion of cash that they have to be able to disgorge to you year after year after year. To do that, they have to make perhaps $80 billion or close to it pre-tax. Now, you might look around at the universe of businesses in this world and see how many are earning $80 billion pre-tax, or 70, or 60, or 50, or 40, or 30, and you won't find any. So it requires a rather extraordinary change in profitability to give you enough birds out of that particular bush to make it worthwhile to give up the one that you have in your hand. Second part of your question about whether we'd be willing to buy a wonderful business at 4 times earnings, I think I could get even Charlie interested in that. But let's hear it from Charlie.
I'd like to know what that is.
He was hoping you would ask that, the fellow that's got all his net worth in this stock and who has a captive audience. Tell us what it is. You got to tell us. We're begging you.
You want the name of the company?
We want the name of the company. We're dying to get the name. Wait till I get my pencil out.
Okay. It's called National RV, and it's based in California, and they sell recreational vehicles.
Okay, well, you've got a crowd of people who have birds in the hand, and we will see what they do in terms of National RV. Charlie, do you have anything further on growth and value, et cetera? Watch him carefully, folks.
Well, I agree that all intelligent investing is value investing. You have to acquire more than you really pay for, and that's a value judgment. But you can look for more than you're paying for in a lot of different ways. You can use filters to sift the investment universe, and if you stick with stocks that can't possibly be wonderful to just put away in your safe deposit box for 40 years, but are underpriced, then you have to keep moving around all the time. As they get closer to what you think the real value is, you have to sell them and then find others. And so it's an active kind of investing. The investing where you find a few great companies and just sit on your ass because you've correctly predicted the future, that is what it's very nice to be good at.
The movie was G-rated even though. Is that it, Charlie? Okay, we will move to area 2.
Good morning, gentlemen. Wayne Peters. And where I come from, our ladies are referred to as birds. And I'm sure I know a lot that would trade one in the hand for 2 in the bush, irrespective of the interest rate. I have two small questions. Firstly, with the speculation, and some would say rampant speculation in the high-tech and internet arenas, could you share your views on the potential fallout from this speculation for the general economy? And secondly, how long did it actually take you to perfect that curveball? And are we going to see it tonight?
I don't think I want to give anything away about my pitches tonight. Ernie Banks may be in the audience. I know he's in town, and I just can't afford to do that. But you'll see it tonight, and you can describe it any way you'd like. The question about the high-tech stocks and possible fallout. Anytime there have been real bursts of speculation in the market, that it does get corrected eventually. Ben Graham was right when he said that in the short run it's a voting machine, in the long run it's a weighing machine. Sooner or later, the amount of cash that a business can disgorge in the future governs the value it has, that the stock commands in the market. But it can take a long time. And it's a very interesting proposition. For example, if you take a company that in the end never makes any money, but the trade changes hands representing a valuation of 10 or 20 billion dollars for some time, there's no wealth created. There's a tremendous amount of wealth transferred. And I think you will see, when we look back on this era, you will see this as a period of enormous amounts of wealth transfer. But in the end, the only wealth creation comes about through what the business creates. There's no magic to it. If a company that's not worth anything sells for 20 billion, and 5% of it changes hands, somebody takes $1 billion from somebody else. But investors as a whole gain nothing. They all feel richer. It's a very interesting phenomenon, but they can't be richer except as a group unless the company makes them richer. And it's the same principle as a chain letter. I mean, if you're very early on a chain letter, you can make money. There's no money created by chain letters. In fact, there's the frictional cost of envelopes and postage and that sort of thing. So the net, there's some money destroyed a little bit. And there's money destroyed by the frictional costs of trading and investing. That comes out of investors' pockets. But the manias that periodically take place, and not just in stocks. We had a similar mania. Well, I'm not necessarily similar. We certainly had a mania in farmland here in Nebraska 20 years ago, and land which couldn't produce, we'll say, more than $70 or $80 an acre would sell for $2,000 an acre at times when interest rates were 10%. Well, that math will kill you. And it killed the people who bought it at those prices, and it killed a great many banks here in Nebraska who lent based on that sort of thing. But while it was going on, everybody thought it was wonderful because every farm was selling for more than the similar farm had sold for a month earlier. And it was momentum investing in farmland. And in the end, valuation does count, but it can go on a long time. And when you get a huge number of participants playing with ever-increasing sums, it creates its own apparent truth can be for a very considerable period of time. It doesn't go on forever, and whether it has fallout to the whole economy, like it probably did in the late 20s, or whether it's just an isolated industry or sector where the bubble bursts and it really doesn't affect other values, who knows? But 5 or 10 years from now, you will know. Charlie?
Well, I think the reason we use the phrase wretched excess is that there are wretched consequences. If you mix the mathematics of the chain letter or the Ponzi scheme with some legitimate development like the development of the internet, you are mixing something which is wretched and irrational and has bad consequences with something that has very good consequences. But if you mix raisins with turds, they're still turds.
That's why they have me write the annual report. So I think we better move on to Sector 3.
My name is Thomas Kamei. I'm 10 years old and I go to basic school in Kentfield, California. I have been a shareholder for 2 years. This is my 3rd annual meeting. Here's my question. I know you won't invest in technology companies, but are you afraid that the internet will hurt some of the companies that you do invest in, such as the Washington Post or Wells Fargo? Thank you.
Well, that's an absolutely terrific question. You know, I may turn my money over to you. There's probably no better question we'll get. And I hope Charlie answers in an appropriate vein, considering your age. We do not. We have no. You know, it's no religious belief that we don't buy into tech companies. We just don't. We have never found one, as conventionally defined. We've never found one where we think we know enough about what the business will look like in 10 years that we can make a rational decision as to how much we pay now for that business. In other words, we have not been able to find a business where we think we know what that bush will look like in 10 years and how many birds will be in it, so that we know how many birds we can give up today to participate in that future. Not any. There will be wonderful things, as Charlie so colorfully explained, that will evolve from many of these companies, but we don't know how to make that decision. And you're absolutely right that we should be thinking all of the time about whether developments in that tech area threaten the businesses that we're in now, how we might counter those threats, how we might capitalize in opportunities because of it. It's a very, very, very important part of business now, and will become more important in the years to come, including many of our businesses. And for example, you mentioned the Washington Post. Even closer to home, we own a newspaper called the Buffalo News in Buffalo, New York. We own all of that, so we're in a position to make our own decisions of an operating nature as to what we should do in respect to the internet. And believe me, Stan Lipsey, who's here today, who runs that paper, and I have talked many, many hours, including considerable time yesterday, about what we are doing on the internet, what we should be doing, what other people are doing, how it threatens us, how we can counter those threats, all of that sort of thing. And newspapers are a category that, in my view, are very threatened by the internet, because we had an example. The internet is terrific for delivering information. We have a product, World Book, that's terrific for delivering information. And 15 years ago, print encyclopedias were the best tool, probably, for educating not only young children, but for educating me or Charlie when we wanted to look up on something on a subject. And the World Book is a marvelous product, but it requires chopping down trees, and it requires operating paper mills, and it requires binding and printing, and it requires a delivery of a 70-pound UPS package. And it was put together in a way that was, for 400 or 500 years, the best technique for taking that information and moving it from those who assembled it to those who wanted to use it. And then the internet changed that in a very major way. So we have seen firsthand and experienced the business consequences of the improvement offered by the internet in the delivery of information. And newspapers, although not as immediately susceptible to that problem, still face that overpowering factor. When you eliminate the delivery cost, I mean, we pay a significant percentage of our circulation revenue to our carriers, and we pay additional money to the district managers, and we pay for the trucks to deliver the product out, and we pay for huge printing presses and all of that sort of thing. And people do chop down trees in order to give us the raw material to transmit information in Buffalo, you know, about what the Buffalo Bills did yesterday on Sunday with all the details. And now you have the internet that has virtually no incremental unit cost to anything and can deliver the information instantaneously. So it's a big factor for newspapers. And the newspaper world, in my view, will look very, very, very different in not that many years. And I find it kind of interesting because the people in the newspaper business are a little schizophrenic about this. They see this, they're afraid of it, they're in almost all cases trying to combat it in some way operationally, but some of them at least continue to go out and buy papers at a price that sort of reflects the economics that used to exist 20 years ago, when it's, to me, it's very clear that it doesn't exist anymore. So they sort of have their billfold, you know, in the past, even though they see the future. And you know, I think probably they're making mistakes in many cases. All of our businesses, virtually, Coca-Cola will not be affected in any significant way by the internet. You know, the razor and blade business won't be, although you could dream up things about distribution or so on. But I think that it's very unlikely. But other businesses we have, our insurance business, particularly at Geico, will be very affected by the internet. Now, that may turn out to be a big advantage to us over time. I wouldn't be surprised if it is. But our retailing businesses are all threatened in one way or another by internet developments, and there may be some opportunities there too. But it's a change. It's a change, and it's going to be change in the world, how the world gets entertainment. It's going to be change in the world, how the world gets information, and it is incredibly low cost compared to most of the methods of conveying entertainment and information now. Charlie?
Willie asked if we were afraid if the internet would hurt some of our business, and I think the answer is yes.
I'm learning to appreciate these short answers, though, Boris, the day goes by. I want to thank you for coming to our meeting, incidentally. You're way ahead of me. I didn't buy my first stock until I was 11, and so you've got a real jump on me, and I wish you well. Okay, Area 4.
My name is Greg Blevins from Bardstown, Kentucky. I have a question about intrinsic value. It comes from comments that you made in your annual report this year. In there, you describe the extraordinary skills of a jet in judging risk. When I think about Berkshire and its ability to increase intrinsic value, it seems to me that judging risk has been at least as important as an ability to calculate a net present value. So my question to each of you is, would you give us some comments on how you think about risk?
Well, we think of business risk in terms of what can happen, say, 5, 10, 15 years from now that will destroy or modify or reduce the economic strengths that we perceive currently exist in a business. And some businesses, it's impossible to figure, or at least it's impossible for us to figure, and then we don't even think about it then. We are enormously risk averse. We are not risk averse in terms of losing $1 billion if there were an earthquake in California today. And we're thinking of writing a policy, for example, in the next week or so on a primary insurance risk of over $1 billion. That doesn't bother us as long as the math is in our favor. But in terms of doing a group of transactions like that, we are very risk averse. In other words, we want to think that we've got a mathematical edge in every transaction, and we think that we'll do enough transactions over a lifetime so that no matter what the result of any single one, that the group expectancy gets almost to certainty. When we look at businesses, we try to think of what can go wrong with them. We try to look at businesses that are good businesses now and we think about what can go wrong with them. If we can think of very much that can go wrong with them, we just forget it. We are not in the business of assuming a lot of risk in businesses. And that doesn't mean we don't do it inadvertently and make mistakes, because we do. But we don't intentionally or willingly, voluntarily go into situations where we perceive really significant risks that the business is going to change in a major way. And that gets down to what you probably heard me talk about before, is what kind of a moat is around the business. Every business that we look at, we think of as an economic castle. And castles are subject to marauders. And in capitalism, any castle you have, whether it's razor blades or soft drinks or whatever, you have to expect that. I mean, you want the capitalistic system to work in a way that millions of people are out there with capital thinking about ways to take your castle away from you and appropriate it for their own use. And then the question is, what kind of a moat do you have around that castle that protects it? See's Candy has a wonderful moat around its castle. And Chuck Huggins has taken that moat, which he took charge of in 1972, and he has widened that moat every year. He throws crocodiles and sharks and piranhas in the moat, and it gets harder and harder for people to swim across and attack the castle. So they don't do it. If you look since 1972, Forrest Mars tried with Ethel M., I don't know, 20 years ago, and I hate to think of how much money it cost him to try that. And he was a very experienced businessman. So we think in terms of that moat and the ability to keep its width and its impossibility of being crossed as the primary criterion of a great business. And to our managers, we say we want the moat widened every year. That does not necessarily mean that the profit is more this year than last year, because it won't be sometimes. But if the moat is widened every year, the business will do very well. When we see a moat that's tenuous in any way, getting back to your question, it's just too risky. We don't know how to evaluate that, and therefore we leave it alone. We think all of our businesses, virtually all of our businesses, have pretty darn good moats, and we think the managers are widening them. Charlie?
How could you say it better?
Oh. Here, have some peanut brittle on that one. Okay, 6.
Good morning, Mr. Buffett, and good morning, Mr. Munger. My name is Mohnish Pabrai, and I'm from Long Grove, Illinois. I have been a student and disciple of yourself, Mr. Buffett, for some time, and especially Mr. Munger. And I have adopted quite intensely your theories on capital allocation in the manner in which I run my business as well as my portfolio, and quite pleased with the results so far. My question has to do with the original 1950s Buffett partnerships. There is some conflicting data in the various books about you pertaining to the rules of the partnership and the fees of the partnership. What I wanted to understand is, I think some of the books allude to the principal being guaranteed, I think 6% a year being guaranteed, and then you took a fourth and the partners got 3/4. In some cases they talk about 4%, in some cases they say there was no guarantee. I would just appreciate a clarification on that.
Okay, we'll make it short, because I'm not sure how much general interest there is to that. But there was never any guarantee. There was a guarantee that I wouldn't get a penny myself. There was none of this 1% fee and all that sort of thing that hedge funds now normally have. So after a short period of time, I told people I'd have all my capital in it, basically. So there was a guarantee I would have a common destiny. There was never any guarantee of principal of any sort. Originally, the thing started by accident, so that there were 11 different partnerships before they all got put together on January 1st, 1962 into Buffett partnerships. So with the 11 different partnerships, they had some different arrangements based on the preferences of the limited partners. I offered them an option of 3 or 4 different choices, and different families made different choices. When we put them together, we settled on the 6% preferential with a quarter of the profits over that, with a carry forward of all deficiencies. Nobody was guaranteed anything on them. Charlie had a much better partnership. His was the third, as I remember, wasn't it, Charlie?
Yes, but we were smaller and operating specialist posts on the stock exchange.
Yeah.
Facts were different.
Yeah. Okay, let's go to 8.
My name is Jinting Wang from San Diego, California. What's that? Oh, yes. First, I would thank both of you. My question is also about growth and value. If you look at the business in this country, most of them, if not all of them, are cyclical to various degree. Certain businesses are, of course, more cyclical than other businesses. So when you buy a business or make an investment in stock, do you have a cutoff? Like if a business loses money in a downturn, we are not going to buy. If its earning begin to decline in a downturn, we are not going to buy. But if the earning growth slows down, then we can look at the business and make an investment. So do you have a cutoff in terms of this cyclical factor? And also, when you buy a business, in terms of the current PE ratio, also do you have a cutoff? Let's say if its PE ratio is more than 15, 16, we are not going to buy the business no matter how much the earning may grow in the future. And so basically it's about the growth and value.
Yeah, we have, to answer your question directly, we have no cutoff whatsoever. We don't think in terms of absolutes that way because, again, we are trying to think of how many birds are in the bush. And sometimes the number that are currently being shown could be negative. One of the best buys we ever made was in 1976 when we bought a significant percentage, what became through repurchases 50% of Geico, at a time when the company was losing a lot of money and was destined to lose a lot of money in the immediate future. And you know, the fact they were losing money was not lost on us, but we thought we saw a future there that was significantly different than the current situation. So it would not bother us in the least to buy into a business that currently was losing money for some reason that we understood and where we thought that the future was going to be significantly different. Similarly, if a business is making some money, there's no PE ratio that we have in mind as being a cutoff point at all. There are businesses, I mean, you could have some business making a sliver of money on which you would pay a very, very high PE ratio, but it's basically, we look at all of these as businesses. We are, for example, at Executive Jet, NetJets, we're losing money in Europe. Well, we expect to lose money in Europe getting established. So does that mean it's a bad thing to buy 100% of if you own the whole company, or 3% of if Executive Jet was a public company and you were buying into it? No, I mean, there are all kinds of decisions that involve the future looking different in some important way than the present. Most of our decisions relate to things where we expect the future not to change much. But you get this, well, American Express was a good example. And when we bought it in 1964, a fellow named Tino DeAngelis had caused them incredible trouble. You know, it was one of those decisions that looked for a time as if it could break the company. So we knew if you had been charging for what Tino had stolen from the company against the income account that year, or the legal costs that were going to be attached to it, you were looking at a significant loss. But the question was, what was American Express going to look like 10 or 20 years later? And we felt very good about that. So there are no arbitrary cutoff points, but there is that focus on how much cash will this business deliver, you know, between now and kingdom come. Now, as a practical matter, if you estimate it for 20 years or so, the terminal values get less important. So, but you do want to have in your mind a stream of cash that will be thrown off over, say, a 20-year period that makes sense discounted at a proper interest rate compared to what you're paying today. And that's what investment's all about. Charlie?
Yeah, the answer is almost the exact reverse of what you were pointing toward. A business with something glorious underneath, disguised by terrible numbers that cause cutoff points in other people's minds, is ideal for us if we can figure it out.
Yeah, we've had a couple of those in our history that have made us a lot of money. I mean, we don't want to wish anybody ill, but...
Oh, I wouldn't go that far.
Okay, well, Charlie... I think he's speaking for both of us. Okay, we'll move on to number 2.
My name is Gaylord Hanson, and I'm from Santa Barbara, California, where Mr. Munger puts his big multi-million-dollar boat in the water.
I'm not going to make any comment on that.
Please don't. Now, with technology, computers, electronics, and software transforming our entire world, not just here, the world, I must admit that I personally invested in 4 technology, computer, software, and aggressive growth mutual funds and made up all of my 1999 losses on Berkshire Hathaway. Are we asking too much as shareholders of Berkshire Hathaway for you men to put your brains to work and possibly speculate a little bit, maybe 10% of our money into the only play in town, which seems to be technology, electronic, and I've read your report and I understand a lot of your reasoning that it's difficult, and it is difficult, to project earnings of a lot of people. They're going to go bankrupt or they're going to go out of business, but isn't there enough left in your brain power to maybe pick a few and see what's going on? Because I made over 100% profit in 1999 on my aggressive position in the technology field. So that's
okay, well, the answer is we will never buy anything we don't think we understand. And our definition of understanding is thinking that we have a reasonable probability of being able to assess where the business will be in 10 years. But, you know, we'd be delighted. We have a man here who's done very well, and if he has any business cards, you know, you can always invest with him, and we'd welcome, you know, we'll give you a booth at our exhibitor section, and anybody that wants to do that is perfectly obviously free to do it with you or through anybody else that they select. Now, you have a whole bunch of people out there that say they can do this, and maybe they can and maybe they can't, and maybe you can spot which ones can and can't. The only way we know how to make money is to try and evaluate businesses. And if we can't evaluate a carbon steel company, we don't buy it. It doesn't mean it isn't a good buy. It doesn't mean it isn't selling for a fraction of its worth. It just means that we don't know how to evaluate it. You know, if we can't evaluate the sensibilities of putting in a chemical plant or something in Brazil, we don't do it. If somebody else knows how to do it, you know, more power to them. There are all kinds of people that know how to make money in ways that we don't. But, you know, it's a free world and everybody can invest in those sort of things. But they would be making a mistake, a big mistake, to do it through us. I mean, why pick a couple of guys like Charlie and me to do something like that with when you can pick all kinds of other people that say they know how to do it? I would say this, incidentally. You mentioned a point earlier, which is how the popular press tends to think of things, but we don't consider ourselves, Charlie and I don't, richer or poor based on what the stock does. We do feel richer or poor based on what the business does. So we look at the business as to how much we're worth, and we do not look at the stock price, because the stock price doesn't mean a thing to us. I mean, it doesn't for a variety of reasons, but beyond that, imagine trying to sell hundreds of thousands of shares at the stock price. We can always sell the business. We're not going to do it, but we can always sell it for what the business is worth. We can't sell our stock for necessarily what the stock price is. So we look at the business entirely as in terms of evaluating our net worth. We figure our net worth went up very, very slightly in 1999. And we would figure that no matter what the stock was selling for. It just doesn't make any difference. because we do look at the businesses. We really look at it as if there wasn't any quote on the stock, because we don't know what the stock is going to do. If the business gets worth more at a reasonable rate, the stock will follow over time, but it won't necessarily follow week by week or month by month or year by year. We had a lousy year in 1999, but the stock price did not calibrate with that in any perfect or close to perfect manner. And we've had good years other times when the stock price is way overpriced or over-describe what happened during the year. So we really measure it all the time by the business. We think of it as a private business, basically, for which there's a quotation, and if it's handy to use that quotation, either in buying more stock or something of the sort, we may do it, but it does not govern our ideas of value. Charlie?
Yeah, generally I would say that if you have a lot of lovely wealth in a form that makes you comfortable, and somebody down the street has found a way to make money a lot faster in a way you don't understand, you should not be made miserable by that process. There are worse things in life than being left behind in possession of a lot of lovely money. I mean,
would you want to name a couple? No, Charlie, I mean, when farmland farmland probably tripled here in the late 70s without any real change in yields per acre or the price of the commodity. Are we going to sit around and stew because we didn't buy farmland at the start? Are we going to stew because all kinds of uranium stocks in the 50s, or you can go back all kinds of things that the conglomerates in the late 60s, the leasing companies. I mean, you can just go down the line, and it just doesn't make any. We're not in that game. We would know how to create a chain letter, believe me. I mean, we've seen it done so many times. We know the game, but it just isn't our game. Charlie? Okay. Number 3.
Okay, my main question is this. Much has been written by you and a lot more by other people about your criteria or the criteria you use when you make a purchase of a company, either in full or in part. But almost nothing has been written by you, at any rate, as far as I can tell, on your criteria for selling a company that you have previously purchased. And I wonder if you could outline the criteria you might apply today to a sale of a company, and whether you would go. Well, the simplest way to put it is this: would you agree with Philip Fisher, who said there were 2 reasons to sell a company or a stock? One was when you discovered you'd made a mistake in your analysis and the company was not what you thought it was. And the second was when something within the company had changed, the management had changed or so on, so it no longer met your original criteria. So are those the principles that you apply, or would you say there are different ones or others? Thank you.
I'm glad you brought up Phil Fisher, because he is a terrific mind and an investor. He's probably in his 90s now, but a couple of books he wrote in the early 60s roughly are classics, and I advise everybody here who's really interested in investments to read those 2 books from the earlier 60s. And he's a nice man. I went out 40 years ago, I dropped into his office in San Francisco, a tiny office, and he was kind enough to spend some time with me, and I'm a huge admirer of his. The criteria that we use for selling a business that we own control of are articulated in the annual report under the ground rules. So in terms of businesses that we own, we have set forth, and I direct you there, we've written those same ground rules every year since 1983, and actually we had those in our head for decades before that. And we have this quirk, which you should understand, and we want our shareholders to understand it, that even though we got offered a price that was far above its economic value as we might calculate it going in, but if we got offered a price for that for a business that we have now, we have no interest in selling it. We don't break off the relationships that we develop simply because we get offered a fancy price for something, and we've had a chance to do that sometimes. That may help us actually in acquiring businesses, because both of the companies that I've committed to buy in the last few weeks, both of them are very concerned about whether they have found a permanent home or not. And people who build their businesses lovingly over 30 or 40 or 50 years frequently care about it. A lot of people don't care about that, and that's one of the things we evaluate when buying a business. We look at the owner and we say, do you love the, in effect, we ask ourselves, does he love the business or does he love the money? Nothing wrong with liking the money. In fact, we'd be a little disappointed if most of them didn't like the money. But in terms of whether the primacy is loving the money or loving the business, that's very important to us. And when we find somebody that loves their business and likes the money but loves their business, we are a very, very desirable home for them, because we're just about the only people that they can deal with of size where we can commit that they are going to be part of this operation really forever, and be able to deliver on that promise. I tell sellers that the only person that can double cross them is me. I can double cross them, but there's never going to be a takeover of Berkshire. There's never going to be a management consultant come in and say, I think you better do this. There's never going to be a response to Wall Street saying, why aren't you a pure play on this or that, and therefore you ought to spin this off. None of that's going to happen. And we can tell them with 100% assuredness that for a very long time, that if they make a decision to come with Berkshire, that decision will be the final decision as to where their company resides. So unless those couple conditions, which are extremely unusual, that are described in the ground rules, prevail, we will not be selling operating businesses, even though someone might offer us far more than logically they're worth. The question about stocks, we're not quite with Phil Fisher on that, but we're very close. We love buying stocks where we think the businesses are so solid, have such economic advantage, that we can essentially ride with them forever. But you've heard me talk about newspapers earlier today. We would have thought newspapers 25 years ago, I think Charlie and I probably thought a daily newspaper, in a single newspaper town, which practically all are, is probably about the solidest investment you could find. We might have thought a network TV affiliated station was about as solid as you could find. And they were very solid. But events have, over the last 20 or 25 years, have certainly changed that to some degree, and maybe to a very, very big degree. So we will occasionally reevaluate the economic characteristics that we see 10 years out from the ones that we saw 10 years ago, and maybe come to a somewhat different conclusion. The first 20 years of investing for me, or maybe more, my decision to sell almost always was based on the fact that I found something else I was dying to buy. I mean, I sold stocks at 3 times earnings to buy stocks at 2 times earnings 45 years ago, because I was always running out of money. Now I run out of ideas. I've got a lot of money but no ideas. And I'm not sure which is better. What do you think, Charlie?
I think you were way better off when you had 50 years ahead of you and less money.
I still think I have 50 years ahead of me, Charlie. You want to elaborate any more on selling?
Yeah, we almost never sell an operating business, and when it does happen, it's usually because we've got some trouble we can't fix.
Okay, number 7.
Good morning, Mr. Buffett and Mr. Munger. My name is Ram Tarakard from Sugar Land, Texas. I've been a Berkshire shareholder since 1987, and always battling with the idea of what really is the intrinsic value for the company. We have seen that over time, a change in book value is a vague indicator of the change in intrinsic value of Berkshire. Although in absolute terms, you have said again and again that intrinsic value. In calculating the book value of Berkshire, our partly owned businesses like Coke and Gillette are valued at their market value. This component of book value fluctuates, often irrationally, depending on the mood of the market. Do you think that using a look-through book value, just like you use look-through earnings is a superior measure for tracking changes in intrinsic value. In fact, I had written a letter to you last August, and I was very pleased to get a response from you personally saying that this approach makes sense. My question is, does this approach really give you a better measure for tracking intrinsic value? And if so, would you consider publishing it in the annual report? Thank you.
Yeah, thanks for the question. I would say that I'm not sure how you phrased it when you wrote me and how I phrased it going back, but look through book value would not mean much, actually. The very best businesses, the really wonderful businesses, require no book value. We want to buy businesses really that will deliver more and more cash and not need to retain cash, which is what builds up book value over time. Admittedly, the prices of marketable securities at any given time are not a great indication of their intrinsic value. They are far better, though, than the book value of those companies in indicating intrinsic value. Berkshire's intrinsic value in a very general way, and trends in it, are better reflected in book value than is the case at a very high percentage of companies. It's still it's not a great proxy. It's the best. It's a proxy that is useful in terms of direction, in terms of degree, in a general way over time, but it's not a substitute for intrinsic value. In our case, when we started with Berkshire, intrinsic value was below book value. Our company was not worth book value in early 1965. You could not have sold the assets for that price that they were carried on the books. No one could make a calculation in terms of future cash flows that would indicate that those assets were worth their carrying value. Now it is true that our businesses are worth a great deal more than book value, and that's occurred gradually over time. So obviously there are a number of years when our intrinsic value grew greater than our book value to get where we are today. Book value is not a bad starting point in the case of Berkshire. It's far from the finishing point. It's no starting point at all of any kind in whether it's the Washington Post or Coca-Cola or Gillette. It's a factor we ignore. We do look at what the company is able to earn on invested assets and what it can earn on incremental invested assets, but the book value we do not give a thought to. Charlie?
Well, I think that's obviously correct.
Oh. He'll come back next year. Number one.
Hello, gentlemen. My name's Dan Sheehan. I'm from Toronto, Canada. First of all, I'd like to thank you for this weekend. It's become more and more important to me as it's become more and more difficult to find rational discussion about the stock market, and this weekend really is a breath of fresh air for most of us, I think. One of the places I refer to a lot is Benjamin Graham, and what worries me now is what he referred to as a period in 1929 and the early 30s as a lab experiment where normal intrinsic values and margins of safety broke down, or seemed to anyway, and I wonder how much you think that might happen now in the next few years, and how much you worry about that with the investments you're making.
Well, we generally believe you can just see anything in markets. I mean, just extraordinary what happens in markets over time. It gets sorted out over, eventually. But I mean, we have seen companies sell for tens of billions of dollars that are worthless, and at times we have seen things sell for 20%. A number of things, not hard to find, perfectly decent people running them, sell for literally 20% or 25% of what they were worth. So we have seen and will continue to see everything. It's just the nature of markets. They produce wild things over time. And one of those wild things, and not to get carried away when other wild things happen, because the wild things create their own truth for a while, and you have to, that's the reason they're happening, and people are getting pleasant experiences and all that. You'll see everything if you're around markets for a reasonable period of time. We don't see we don't see any great cases of dramatic undervaluation by this market. So it isn't like we're seeing, because there's perhaps this speculative mania in a particular area of the market, we do not see that creating incredible undervaluation other places. What's happening there may lead to undervaluation, a few years from now, or it may not. I don't know that, but it isn't like you can find things that are worth double or thereabouts what you're paying, because frankly there's so much money sloshing around that if you found such a thing, it would be very likely corrected by some buyout types. I mean, we would love to find businesses that are selling for half of what they're intrinsically worth. We don't find that.
Well, I do think that the present time is a very unusual period. It's hard to think of a time when residential real estate and common stocks and so on rose so rapidly in price, and there was so much easy money floating around. I mean, this is a very unusual period.
What's fascinating, and I'm sure you thought of it, is that you can now have a business, saw a few of them, earlier this year, we'll say, that might have been selling for $10 billion, where the business itself could not have borrowed probably $100 million in debt with an equity valuation of $10 billion. But the business itself would not, as a private business, would not have been able to borrow $100 million. But the owners of that business, because it's public, can borrow many billions of dollars on their little pieces of paper because they have this market valuation. If it's a private business, the company itself couldn't borrow 1/20th or so what the individuals could borrow. That's happened to a degree before, but this has probably been as extreme as anything that's happened, probably including the 20s. That doesn't mean there's a parallel to it, but it's been pretty extreme. Charlie?
I think it probably is the most extreme that has happened in modern capitalism. In my lifetime, I would say the 30s were it created the worst recession in the English-speaking world in 600 years. And it was very extreme. You could buy all you could eat in Omaha through the 30s for a quarter from Henderson's cafeteria. And now we're seeing the other face of what capitalism can do. And this is almost as extreme as the 30s were, but in a different direction. It's zero unemployment, rampant speculation, et cetera, et cetera. It's an amazing period.
That does not make it easy to predict, however, the outcome.
No.
It says to us, though, certain things we want to stay away from. I mean, basically, it's precautionary to us. It does not spell opportunity, although there's no question that in the last year, the ability to monetize shareholder ignorance has never been exceeded, I think. Wouldn't you say so, Charlie? Okay, number two.
Good morning, gentlemen. My name's Mark Ravenel from Melbourne, Australia. You've emphasised the importance of the moat around a business, or the sustainable competitive advantage. My question really relates to learning more about that. Professor Michael Porter at Harvard has made a detailed study of this. Did you find his work useful, and can you recommend any other sources of information on this?
Yeah, I've never really read Porter, although I've read enough about him to know that we think alike in a general way. So I can't refer you to specific books or anything, but my guess is that what he writes would be very useful for an investor to read. I just see him referred to in some commentary, but I think he talks about durable or sustainable competitive advantage as being the core of any business. And I can tell you that is exactly the way we think. I mean, that in the end, if you were evaluating a business year to year, the number one question you want to ask yourself is whether the competitive advantage has been made stronger and more durable before it, and that's more important than the P&L for a given year. So I would suggest that you read anything that you find that's helpful, or actually the best way to do it is study the people that have achieved that and ask yourself how they did it and why they did it. I mean, why is it that in razor blades, everybody grows up in business school hearing that as a great example of a product that's very profitable, and why, with it obvious that there's going to be no reduction in demand for the next 100 years for the product, why are there no new entrants into the field? What is it that gives you that moat around the razor blade business? Normally, if you got a profitable business, a dozen people want to go into it. If you've got a dress shop here in town and it looks like it's doing well, a couple of other people are going to want to open up a shop next door to it. And here's a worldwide business. Nothing can go wrong with the demand to speak of, and yet people don't go into it. So we like to ask ourselves questions like that. We like to ask ourselves, why was State Farm successful, against people that had incredible agency plants and lots of capital? And here's some farmer out in Bloomington, Illinois, named George Maherl, who's in his 40s. He sets up a company that defies capitalistic imperatives. I mean, it has no stock. It has no stock options. It has no big rewards. It's kind of half socialistic, and all it does is take 25% of the market, away from all of these companies that have all these characteristics. We believe you should study things like that. We think you should study things like Mrs. B out at the Nebraska Furniture Mart, who takes $500 and turns it, over time into the largest home furnishing store in the world. There has to be some lessons in things like that. What gives you that kind of a result and that kind of competitive advantage over time? And that is the key to investing. I mean, if you can spot that, particularly if you can spot it when others don't spot it so well, you're on the, you will do very well, and we focus on that. Charlie?
Yeah, these factors, every business tries to turn this year's success into next year's greater success. And they all use pretty much every advantage they have in every direction from this year to make next year's better. Microsoft did exactly that year after year after year and happened to win big. And it's hard to see, for me at least, to see why Microsoft is sinful, because they tried to improve the products all the time and make next year's business position stronger than last year's business position. I mean, if that's a sin, every subsidiary of Berkshire is a sinner, I hope.
Yeah. We declare ourselves for sin.
My name is Dennis Jean-Jacques from Chatham, New Jersey. I first would like to thank you personally for taking the time out of your busy schedule to visit MBA students throughout the country on a regular basis. In fact, I consider your visit to the Harvard Business School campus many years ago my personal rational awakening. My question is in regard to Dun & Bradstreet. Many academics would argue that two of the many factors that determine a firm's sustainable competitive advantage are the threat of new entrants through imitation and the threat of substitution through technological advances such as the internet and things of that nature. My question is, how deep is the moat around Moody's and the operating company?
Yeah, we don't want to go into too much detail about our marketable investments, but I would say that the moat is, just in our view, is far wider, deeper, and infested with far more poisonous characters in the case of Moody's than in the case of the operating company. If you've had experience just in terms of making decisions about how you either obtain credit information in the case of the operating company, or if you want to obtain ratings on securities or something, I think you'd conclude that Moody's is a much stronger franchise than the operating company. Doesn't mean the operating company can't turn out to be a better business. It might have more upside under certain circumstances too. But if you're really thinking of, what bad can happen to you, I think that you would regard Moody's as a considerably stronger franchise than the operating company. Charlie?
Well, I certainly agree. The Moody's is a little like Harvard. It's a self-fulfilling prophecy. You know, I hate to think of how much you could mismanage Harvard now and still have it work out pretty well.
If you cut the price of the admission to the Harvard Business School by $10,000 a year, you would have less demand, in all probability, than an increase in demand. I mean, it's totally counterintuitive in that respect, because it's the cachet of the school, in that case, is it's not only reinforced, it almost makes it necessary that it be priced toward the top. So you can throw away the demand and supply curves that they teach you in Economics 101 on something like that. Frequently I have a little fun with when I attend business schools, because I ask them, what the definition of a wonderful business is, and we go through all this stuff, and then I say, I tell them that really the best business I've seen is the Harvard Business School or the Stanford Business School, because the more they increase the price, the more people want to get in, and the more people think the product is worth. And that is a marvelous position to be in. And I thank you for your comments on the, I was lucky enough to have a great teacher in Ben Graham at Columbia, and Ben didn't need to go up to Columbia once a week on Thursday afternoon to talk to a bunch of us. So I really feel I enjoy sort of passing that along. I haven't had any original ideas in this field at all, but I had a terrific teacher, and it's fun to talk to students. If you talk to a bunch of guys my age, nothing happens. I mean, they just want to be entertained. But they want predictions always and that sort of thing. So I don't do any of that at all. I'd rather talk to students, and I thank you for coming. Let's go to number 3.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Bob Odom from Seattle, Washington. I'd like to say, first of all, how nice it is to come out to Omaha and how I am made to feel comfortable by its people. I hope you both are as enthusiastic about the meeting as you seem to be in years to come. Mr. Munger, by the way, I am looking forward to your book coming out. My question has to do with Doug Ivester's severance package and what justifies it, considering he had a very short tenure as CEO and that he took the reins from some very strong performance from Consueta and to be relieved of his dismal performance by Doug Daft. My brother, still in the bottling and distribution business of Coke, cut this article from Bottlers World magazine concerning the severance package. He said he also would retire if he were offered this. $97.4 million in stock, $3 million per year for 2000 to 2002, $2 million per year 2002 to 2007, $1.4 million per year from 2007 for the rest of his life. Anyway, I don't see how car and cell phone, he gets that. That's a Mercury Grand Marquis and mobile telephones, laptop computer, and the like. I don't know why you'd need that. Anyway, I've been wondering how you voted on this, whether you supported it or not, or what degree, considering executive pay at Berkshire hasn't risen, except perhaps for the CFO who last got a raise, I believe, in 1997.
You asked, no, CFO's got a raise every year, but you asked whether I supported it. Yeah, I can tell you I supported it because with my 35% interest in 8% of Coca-Cola, I paid almost 3% of it myself personally. I probably paid more severance pay than any man in the history of the world personally. I was not on the comp committee, but I will say this. Doug Ivester did all kinds of really wonderful things for the Coca-Cola company over time. He for many years when Roberto was running things, Doug, and working with Don Keogh too, and I had this firsthand from both of them. I wasn't in Atlanta, but there was no question that he was a huge asset and conceived and carried out many of the things that other people may have gotten even more credit for. Most of what you described, not the little things at the end, but most of what you described was contractually in place at the time that he left. I mean, those were deals that were made, restricted stock and all of that really occurred in significant part when Roberto was the chief executive officer and at Roberto's recommendation. Doug's devotion to Coke, his knowledge of Coke, I mean, he lived and ate and breathed Coke, but in my opinion, Doug Daft was the man for the job, and a change was made. But it was not because of any lack of attention by Doug Ivester. It was not because he hadn't done great things as CFO of the company, but I think he was not the right man at the time he took over as CEO. He took over, as you know, when Roberto died quite suddenly. There wasn't any real option in terms of he was Roberto's hand-picked successor. It's almost inconceivable that somebody else would have been chosen at that time. And we made a decision within a couple of years that the company would move faster and better with Doug Daft in charge, and we made a deal in severance which was about 80% or some very high percentage embedded, and like I say, I paid more of it than anybody else. So it isn't like it was all academic. And I think, considering some other factors, which maybe I'll put in a book sometime, that entered into it, it was definitely the right decision for the Coca-Cola Company. Whether the computer should have been included in the car or anything, I would not want to defend small item by small item, but I think the Coca-Cola shareholders are going to be many billions of dollars ahead over time by what was done then, and it wasn't easy to do. We'll go to 5. And Charlie, do you have anything to add on that? You paid a fair amount too.
Generally speaking, I think it's a mistake for corporate America to create as much hostility as it does, which is based on the way it compensates principal officers of corporations. It is simply maddening to add a little clause that the corporation will scratch the guy's back for just tiny little bits of stuff that looks terrible. To me, that is extremely stupid. And I see it where the corporation helps him prepare his tax return for 10 years after he leaves and so forth. I think that makes a terrible impression on shareholders generally, and I think corporate America is crazy to do it. They get sold this stuff by these damn consultants.
Yeah. I agree with Charlie, and it is true what Charlie says. We don't have a contract, at least that I can think of, at Berkshire. It's perfectly easy to run a company without them. We've got wonderful managers. We've got things that might be called contracts. I mean, we've got deals with them in terms of we tell them what we work out compensation arrangements and all that. I can't remember a case of anybody that's been with us that ever has called in a lawyer or anything of the sort, or we even had to reduce things to writing basically, and it works fine. And it is a little maddening, as Charlie says, to have a CEO, show up with a lawyer with a 20-page contract. I mean, it's become standard operating procedure, and once you get a big public company with committees, consultants to the committees, consultants who usually are picked by the officers of the company, they look around at what everybody else is doing and say, well, that's the way the other guy does it, so I'll do it. I think the proxy statements of the last 20 years, what that's induced in the way of behavior by people at somewhat comparable companies that look at the proxy statements of their competitors and then say to their lawyer, well, Joe Blow got this, why shouldn't I have it? It just escalates and escalates and escalates, and it ratchets, and it won't stop. I have never seen a compensation consultant come into a public company and suggest a plan that net reduces the cost of compensation. And I see all kinds of people leave companies who have made tremendous amounts of money, and nobody wants to hire them at half the price or a quarter of the price or a tenth of the price. I mean, it's not a market system. CEO compensation is not a market system, and it's not subject to market tests. And I don't know what you do about that particularly, but it doesn't seem to bother shareholders very much. The ones that could change
I think it bothers them a lot, Warren. It's just they feel powerless.
Yeah, but the institutional shareholders could change that. My guess is that the top 30 institutions probably control, two-thirds of the big companies in the country, and they don't seem to care that much. They spend their time on what I regard as peripheral issues. Usually, they talk about other things. They get involved in rituals of corporate governance that frankly don't mean a damn in terms of how the company performs, and they seem to ignore these other issues. But we got enough to do running Berkshire, so we can't reform the world on that. We will run Berkshire in a rational manner. And we have yet to hire a compensation consultant, and we've yet to lose an important manager. Okay, we'll go to number 5.
Hello, Mr. Buffett.
Hi.
Mr. Munger. My name is Aaron Wexler. I'm from Santa Maria, California. My question has 2 parts. The first part is when you and Bill Gates had a television show some time ago, you were asked about the people who had different role models, and you said, well, if I know a person's role model, I can pretty well tell what kind of a person he is and what kind of a future he has. Mr. Buffett, my role model is Warren Buffett. Do you think I'll have a chance?
Well, I hope you're choosing me on the basis you hope to expect to live to an advanced age. I'd like to think that that's what I bring to the party. It does pay to have the right models. I mean, I was very lucky very early in life that I had certain heroes, and I've continued to develop a few more as I've gone along. And they've been terrific, and they've never let me down. And it takes you through a lot. And I think that, it just stands to reason that you copy very much the people that you do look up to, and particularly if you do it at an early enough age. So I think if you can influence the role models of a 5-year-old or an 8-year-old or a 10-year-old, it's going to have a huge impact. And of course, everybody virtually starts out with their initial models being their parents. So they are the ones that are going to have that huge effect on them. And if that parent turns out to be a great model, I think it's going to be a huge plus for the child. I think that it beats a whole lot of other things in life to have the right models around. And I have, like I say, even as I gotten older, I picked up a few more, and it influences your behavior. I'm convinced of that. And if you will want to be a little more or a lot more, depending on your personality, like the person that you admire. And I tell the students in classes, I tell them, just pick out the person you admire the most in the class and sit down and write the reasons out why you admire them, and then try and figure out why you can't have those same qualities. Because they're not the ability to throw a football 60 yards or run the 110 flat or something like that. They're qualities of personality, character, temperament that can be emulated. But you got to start early. It's very tough to change behavior later on. And you can apply the reverse of it, following Charlie's theory. You can find the people that you don't like and say, what don't I like about these people? And then you can, if it takes a little strength of character, but you can look inward and say, have I got some of that in me? And it's not complicated. Ben Graham did it. Ben Franklin did it. And it's not complicated. Nothing could be more simple than to try and figure out what you find admirable, and then decide, that the person you really would like to admire is yourself. And the only way you're going to do it is take on the qualities of other people you admire. Anyway, that's a 2-minute answer on something Bill and I did talk a little bit about. Charlie?
Yeah. There is no reason also to look only for living models. The eminent dead are in the nature of things some of the best models around. And if it's a model is all you want, you're really better off not limiting yourself to the living. Some of the very best models have been dead for a long time.
Yeah, Charlie has probably read more biography than any 3 people in this room put together. So he has put this into practice. And as somebody mentioned earlier, Janet Lowe has a biography of Charlie coming out here in later this year. So you can read all the secrets of Charlie's life. Okay, number 7.
Good afternoon, gentlemen. My name is Gary Brodstrom from here in Omaha, Nebraska. And my question is, if Alan Greenspan just decided to retire and that job was offered to either of you, would you take it?
Well, I can tell you my answer is no, in a hurry. I think Charlie will give you his answer.
So I would say no more quickly.
You notice we gave you very unequivocal answers, and of course that alone would disqualify us from the job at the Fed. I think it was Alan that said to one senator, he said, since you seem to have stated my remarks so accurately, you must have misunderstood them. And I don't think you could find a job in public life that would entice either one of us. And the truth is we're having too much fun. I mean, we've got the best job in the world. We get to work with people we like and admire and trust every day of the year. We get to do what we want to do, the way we want to do it. And we should pay, and this is true of some other CEOs too, but we should pay to have this job. I mean, it is really interesting. I've often thought if you could get, you had a sealed envelope and you had the compensation committee say what they would pay to have the job filled, but then you had the chief executive, also say what he would do before he would leave, there would be a huge, huge gap. And I mean, there are all kinds of, it's a lot of fun to start with, interesting problems you come up with, interesting things to do, something different every day. I mean, you can't beat the job, and to get paid for it is just the frosting on the cake. And I don't see any jobs like that in public life myself. And well, Charlie, if you got anything to add, Charlie takes on these public jobs. He runs a hospital and a few things, and he can tell you the wonders of it. Charlie?
Oh yeah. There's an old saying that he lied like a finance minister on the eve of a devaluation. I never wanted to have a job where lying was a required part of the activity.
Hello, Warren. Hello, Charlie. My name is Doug Patterson. I'm from here in Omaha. I teach down the road at the University of Nebraska at Omaha. And I teach in theater, which is also the greatest job in the world. And I have to say that I enjoy the theater you provide every year. Thanks so much.
Thank you.
Just sitting here, there's so many questions that come to those of us who've been sitting here for 3 or 4 hours. I've got 3 very disconnected questions.
Okay, we'll do them one at a time.
Cool. In terms of these tech stocks, you say that you don't understand them. Can you say if you think... I can't imagine you not understanding something.
Oh, we understand the product. We understand what it does for people. We just don't know the economics of it 10 years from now. You can understand all kinds. You can understand steel. I mean, you can understand home building. But if you look at a home builder and try and think where it's going to be in 5 or 10 years, the economics of it, that's another question. I mean, it's not a question of understanding the product they turn out, the means they use to distribute it, all of those sort of things. It's the predictability of the economics of the situation 10 years out, and that's our problem.
Right, and I'm not trying to provoke you into doing it. I'm glad you haven't, because I probably would have gone into cardiac arrest this last couple of months.
Yeah, well, so would we.
Yeah. So, so your projection is that you are not going to try to make an attempt to understand that. You think is it not comprehensible? Is that it? It's not comprehensible?
Yeah, every business I look at, I think about its economics. It's built into me. It's built into Charlie. So it isn't that we shut off the valve. It's just that we don't get any place. We don't know what it'll look like. And it's there are a lot of things in life that they're just beyond comprehension for many of us. And
so you'd say that like nobody really probably can understand this where it'll be in 10 years. Nobody could understand.
We would be very skeptical about it. Yeah, I would say that. And incidentally, my friend Bill Gates would say the same thing. And actually, Bob Noyce would have. Bob died some years ago, or Andy Grove. They would say the same thing. I've taken long walks with Andy, and they would not want to put down on paper their predictions about where 10 companies you would choose in the tech field would be in 10 years in terms of their economics. They would say that's too hard.
My name is Eric Tweedy from Shavertown, Pennsylvania. Thanks again for another great meeting. During last year's meeting, my wife picked up a copy of a book called Buffettology at one of the shops around town. That is written by Mr. Buffett's former daughter-in-law. A very well written book, very interesting, and it attempts to outline the Warren Buffett approach to investing. My question is, I don't know if either of you gentlemen are familiar with the content or have read it, and if so, if you could comment on if you think it is a good outline of that type of investing. My second question related to that, I wonder if Mr. Buffett could comment on why you bought the original textile mill in Massachusetts, and if that represented an earlier phase when you were more of a strictly Graham-style value investor versus your current investment style.
Probably the best. I would say that the most representative book on my views is the one that Larry Cunningham has put together, because he essentially has taken my words and rearranged them in a more order. He's taken them from a number of years, and what he has put together there best represents my views. And we've got 20 years of annual reports or so or more on the internet, plus articles in Fortune, all kinds of things. So it's probably a bias I have, but I like to think that I laid out those views as better than somebody who's rewriting them. But that's I'll let you make that decision. But I do think Larry's done a very good job of taking a number of those reports and rearranging them by topic in a way that makes it a lot easier to read than trying to go through year after year. And actually, you'll have this book about Charlie pretty soon to read too. But we've said what we've said in these meetings, we've said in the annual reports, we've said exactly what we do. And some of the books, I would say, try to take that, and because people are looking for mechanistic things or formulas or whatever it may be, they may try to hold out that there's some secret beyond that. But I don't think there probably is. And Charlie, you've read the books.
Well, I skimmed that book. I think what we have done all these years is it wasn't all that hard to do, and it's not all that hard to explain. All that said and done, I think a lot of people just don't get it. As Samuel Johnson said famously, I can give you an argument, but I can't give you an understanding.
What was the second part again?
I just asked you if you could maybe comment on why you bought the original Berkshire textile mill.
That's why I didn't remember.
If I could say one of the things, someone tapped me on the shoulder and asked me for you not to forget to give the current year's recommended books.
I got to recommend the book on Charlie. But I'll let Charlie recommend one too. The original purchase of Berkshire was a terrible mistake, and my mistake. No one pushed me into it. It was I bought it because it was what we used to call the cigar. It was a cigar butt approach to investing, where we would look around for something with a free puff left in it. You know, it was soggy and kind of disgusting and everything, but it was free. And Berkshire was selling below working capital, had a history of repurchasing shares periodically on tender offers, and it was selling it. First purchase was, I think, at $7.50 a share. In fact, I've got the broker's ticket up in the office, 2,000 shares, and it looked to me like they were going to have a tender offer periodically, and there would probably be at some figure closer to net working capital, which might have been $11 or $12 a share, some such number, and we would sell on the tender. And that was, we had other securities we owned that way, and we bought some that way. And then, actually, I met Seabury Stanton one time, who was running Berkshire, and he told me and made me an insider, so I couldn't do anything. But he said he was thinking of having a tender, and he wondered what price we'd tender at. And as I remember, I may be wrong on this. I could look back on it, but I think I said 11 3/8. And he said again to me, "Well, if we have a tender at 11 3/8, will you tender?" And I said, "Yes, I will." And then I was frozen out, obviously, of doing anything in the stock for a little while. But then he came along with the tender offer, and as I remember, I opened the envelope and it was 11 1/4. I may be wrong. It was maybe 11 1/2, 11 3/8. But it was an eighth below what he had said to me and what I'd agreed to. So I found that kind of irritating, and I didn't tender. And then I bought a lot of stock, and I bought Kim Chase, who's a director. His father had some members of the family, not his direct family, but a related family, that wanted to sell a block. And we bought several blocks, and before long we controlled the company. So at an eighth of a point difference, we wouldn't have bought it, the company, if they'd actually tendered at that price. We had a somewhat similar thing happen with Blue Chip, actually, later on, too. Now, we would have been much better off if we hadn't bought it, because then things like National Indemnity and all of that, instead of buying it into a public company with a great many other shareholders, we would have bought it privately in the partnership, and our partners would have had a greater interest. So Berkshire was exactly the wrong vehicle to use for buying a bunch of wonderful companies over time. But I sort of stumbled into it, and we kept moving along, and when I disbanded the partnership, I distributed out the Berkshire because it seemed like the easiest and best thing to do. And I followed through, and I enjoyed it enormously. I'm glad it all worked out this way. It did not work out the best way economically, in all probability. It was the wrong base to use to build an enterprise around, but maybe in a way that's made it more fun. Charlie, do you have anything to add on that? You can tell them about the Blue Chip story.
No, one such story is enough. But it is interesting that a wrong decision has been made to work out so well. We've done a lot of that, scrambled out of wrong decisions. I'd argue that's a big part of having a reasonable record in life. You can't avoid the wrong decisions, but if you recognize them promptly and do something about them, you can frequently turn the lemon into lemonade, which is what happened here. Warren twisted a lot of capital out of the textile business and invested it wisely, and that's why we're all here.
But Berkshire comes from three companies that came together: Diversified Retailing, Blue Chip Stamps, and Berkshire. Those were the three base companies. And Diversified started when we bought a company called Hochschild Kohn in Baltimore in 1966, a department store, and that company disappeared over time. Fortunately, in 1970, we sold it to Supermarkets General. Blue Chip, we've told you about the record of that. So we started out with three disasters and put them all together, and it's worked out pretty well. But it was a mistake to be working from that kind of a base. Don't follow our example in that respect. Start out with a good business and then keep adding on good businesses.
But the example of quickly identifying the mistakes and taking action, their example is a good one.
Yeah. Okay, number 6.
Mr. Buffett, you've known Bill Gates for several years and probably spent more time with him than any of us in this room. Would you feel
that isn't the case if Jeff Rakes is here? I don't know. Is Jeff here? No. Anyway, go ahead. But we did have a local fellow who comes from 30 miles from here, Jeff Rakes, who's a key Microsoft employee, and I think he's in town this weekend. I thought he was at the meeting. But
I didn't mean to make the broad generalization to be argumentative.
I just didn't want to think Jeff. I was trying to muscle him out.
Sure. That being said, I guess here's the way I'll rephrase this. Would you feel comfortable sharing with us how your relationship began, how it evolved with Mr. Gates, and with regard to his spirit and competitive nature, how vigorous do you expect him to defend his company's position against the government and state's current antitrust suit? And then for both of you, Mr. Munger included, what, in your opinion, are the odds that the government and the states will prevail and split his company into pieces? And then since Mr. Munger mentioned, I guess I'd ask, could we have an update on the company's silver position and its future as an investment as well? Thank you for opening that door.
Okay, well, he can close them too. Yeah, I really don't feel comfortable speaking for Bill at all in terms of what he's going to do. In fact, I think they've been out quite outspoken, he and Steve Ballmer both, about what Microsoft will do. So I don't want to try and rephrase that or modify it or do anything else, because they know what they're saying when they say it, and I would take them at their word, and I really shouldn't be adding anything to it. I met Bill because a very good friend of mine, Meg Greenfield, was the editorial page editor at the Post. She called me one time 10 or more years ago, and she said, Warren, she loved the state of Washington and had grown up out there. So she said, can I afford to buy a second home? She was living in Washington, D.C. now, and so she said, can I afford to buy a second home in Washington? And I said, and she said, I'll send you all my financial information. I said, Meg, you don't need to. Anybody that asks me whether they can afford something can afford it. It's the people that don't ask me, they never can afford it. So I said, just go do it, and it'll make you happy. And so she did. And then a year or two later, she wanted to have me come out and see what she'd done, with my mild encouragement. And so I went out there and visited. It was the July 4th weekend in 1991, and they had this parade on this island and everything she wanted me to see, and she had a few other people out too. And then she was a friend of Bill's parents, and so we went down there to the Hood Canal to visit them when I was back there to meet the parents. And I think Bill didn't want to come, but Kay Graham was coming in. He wanted to meet her. He didn't want to meet me. And so he came in, and then we hit it off immediately. We had a great time. And, I mean, he had this chimpanzee to whom he was going to try and explain this technical stuff, but I was kind of an interesting chimpanzee to him. So, he's a terrific teacher. So we spent a number of hours, and we just plain hit it off. And I found it very interesting what he had to say, and we've had a good time ever since. And we play bridge together and golf together, so I can tell you that he's quite competitive in those games. But I can't tell you anything about Microsoft or anything. I don't know that much about it. It wouldn't be right if I did know anything personal to be talking about it. Charlie, you know Bill.
Yeah, well, I don't want to speak for anybody else either. I happen to be quite sympathetic to the Microsoft side of the pending antitrust case. But and regarding silver, all I can say is so far it's been a dull ride.
Hi, Mr. Buffett and Mr. Munger. My name is Will Obendorf. I'm from San Francisco, California, and I'm 11 years old. I have been a shareholder for 6 years at Berkshire Hathaway. My questions are, what are GEICO's sustainable competitive advantages? And my other one is, what are the implications of the internet on pricing for the auto insurance industry?
Well, we're going to get your name and send it to Human Relations or whatever they call those departments. We want to hire you. The sustainable competitive advantage at GEICO is to be the low-cost producer providing very good service. And there will be a number of companies that provide good service. So that does not distinguish us from a great many competitors. Having the low cost is crucial. There are companies that specialize in given groups of policyholders, but smaller groups, such as USAA, that have very good costs. So they are very, very competitive with us in their chosen area. There's another company in Los Angeles that geographically, called 21st Century Insurance, that has costs like ours. And so they are extremely competitive within that geographic area. I don't think anybody is any better than us who operates nationwide. We don't operate in Massachusetts or New Jersey, but in the other 40 states, we will have a quote for about anyone. So in terms of a broad-based auto insurance competitor, our competitive advantage has to be low cost over time. Now, we also have to be as good at distinguishing among the risks posed by different kinds of drivers as other people. In other words, we have to be able to select people who are going to be better than average drivers, and we have to be able to understand who was likely to be a poorer than average driver. And the ability to do that, to distinguish those people, would be a competitive advantage. I think that many companies tend to be fairly equal on that point. So it's really at this cost level. And we care very much about cost, the same way that Charlie mentioned a company called Costco does, in terms of retailing. They figure their expense ratios out to hundredths of a percent, and that is important. So that is the competitive advantage. Now, when you get, and we have to sustain and widen that if possible. The question of the internet, it's going to be very important. It already is important to GEICO. It will be more and more important. It will be important to the insurance industry. Because when you have the internet, you have a situation where somebody thinking about insuring a car can click to one place, find out what that rate will be. They can click to someplace else and find out what that rate will be. So in effect, they can shop all around without going from place to place to place and driving all over town or calling lots of agents. They can just do it right there in their den. And that makes it very important, again, that we be the low-cost company. I think it's going to be an advantage for us over time. For one thing, I think it makes brand very important, because we want people to be thinking of GEICO as one of the possibilities to call. And if you've got the XYZ company that nobody's ever heard of, nobody's going to think about clicking on them. And GEICO's brand is becoming extremely familiar to people throughout the country, and we're spending a lot of money to make it even more familiar. So you've asked two very good questions, and I think we're in pretty good shape on both of them. Thank you. Charlie? Number 3.
Good afternoon, Mr. Berkshire, Mr. Hathaway. My name is Anthony Priest. I'm from Washington, D.C. A couple months ago, I saw an ad in the Wall Street Journal where it said Berkshire Hathaway wants to see real estate finance opportunities in excess of $100 million. I was curious about your thoughts in this area, real estate field, some of your goals, if you can talk about any of the deals you may have made, and if Donald Trump has given you a call yet.
I don't think Donald Trump will give us a call. We have got about, 3 deals that we've put on in the last couple of years in real estate, and they are in this $100 million and up category. And we're willing to put billions and billions of dollars in if we can find the right sort of opportunities, or nothing may happen depending on the market. We don't have a lot of places have a mortgage department, or they have a real estate department, and they sort of have a budget and they put money out based on using up the budget, and they have a whole bunch of people that don't have a job unless they do that. That's not the way we operate at Berkshire. We're willing, if the deals are right, we'll do many billions. If the deals aren't right, we don't have anybody whose job is dependent on keeping busy in a field like that. So we look at the deals when they come in. Mike Goldberg is in charge of that operation, and we kick things around. He's in the office right next to mine, so if he hears about a deal, we'll discuss it for 3 minutes, and we'll sort of know whether it passes the first threshold, and then we'll go on to the second and the third. But we don't waste a lot of time on things, and we don't care whether we make another deal or not. We'd like to if the terms are right. And that ad produced some inquiries, not from Donald Trump, and there's one or two, a couple of them are alive at the present time, and we'll see whether they work out. Real estate deals, by their nature, take longer to to put to bed than the kind of thing we normally do. In fact, I can buy a business faster than we can make a real estate deal usually. That's just the way they work. But we could end up with, I mean, we're very happy with the 3 deals that we've got. They're good uses of money, and I hope we find a lot more, but if we don't, I won't be upset. Charlie, do you have anything to add? Charlie's our real estate expert. Huh? Hardly. We are not financing Charlie's boat, incidentally, despite the rumors. Number 4.